Right now, across Canada, everyone is asking the same question. Are housing prices finally coming down? And is this the right time to buy? You see the headlines every day. You see the for sale signs sitting on lawns a little longer than they used to. But here is the part almost everyone is missing. In today's market, a home can actually become more expensive, even if its sticker price goes down. Let that sink in for a moment. Prices can fall, and affordability can still get worse. Welcome back to Canadian Wealth Lab, where we break down how money, housing, and the economy actually connect. Most people still think housing works the old way. The logic was simple. If prices go up, homes are expensive. If prices go down, homes become affordable. But that logic is officially breaking, because housing in Canada isn't just about the price tag anymore. It is about the payments. And those payments are controlled by the most powerful and often underestimated force in real estate: interest rates. Let's look at the math, because the numbers do not lie. Imagine a home with a $700,000 mortgage at a 2% interest rate. Your monthly payment would be roughly $2,900. Now, let's say the market softens. The price of that house drops by a massive $100,000. You are thrilled. You think you're getting a life-changing deal. But there is a catch. Interest rates are no longer 2%. They are now 6%. That $600,000 mortgage at 6% now costs you $3,800 a month. You saved $100,000 on the sticker price, but you're paying $900 more every single month. Over a standard 5-year term, that is an extra $54,000 going straight to the bank. And that is before we even talk about whether or not you can actually qualify for the loan. This is why the current market feels so confusing for so many people. You hear that prices are softening in major hubs like Toronto or Vancouver, yet buyers feel more locked out than ever before. That is not a contradiction. It is a fundamental shift in how affordability works. The real bottleneck in the Canadian dream is no longer the price. It is the financing. In Canada, this effect is amplified by the mortgage stress test. Banks do not just look at today's rate, they test your finances at a rate that is usually 2% higher to ensure you can survive future increases. This means your buying power is often slashed much faster than prices can drop. Even if prices look better on paper, the affordability ceiling for the average family has stayed exactly where it was, or in many cases, it has moved even further out of reach. At the same time, we have to look at the other side of the equation, the sellers. Millions of Canadian homeowners are currently moving through renewal cycles that look nothing like the ultra-low rate era of the last decade. Some are seeing their payments double. But contrary to what many crash predictors expected, this hasn't led to a flood of desperate fire sales. Instead, the market has entered a deep freeze. Housing is a slow-moving asset. Unlike a stock chart that can plunge 30% in a week, housing reacts through time and friction. People don't trade their homes every day based on a ticker symbol. They move when life forces them to, because of a job change, a divorce, or a growing family. When affordability tightens like this, the market doesn't always crash. It stalls. Transactions drop because fewer buyers can qualify, and fewer sellers are willing to accept the new reality. Everything happens slower. So if you're sitting on the sidelines waiting for a price drop to solve your problems, you might be waiting for a ghost. The next major move in Canadian housing may not come from prices first. It will likely come from financing conditions changing underneath everything else. If borrowing costs stay elevated, affordability remains tight, even if prices drift lower. But the moment borrowing costs fall meaningfully, demand could return much faster than prices can adjust. potentially sparking the next wave of competition. The old rule no longer holds. Lower prices do not automatically mean a better deal. In today's housing market, the cost of money matters more than the price of the home. That is the shift most people are still adjusting to. If you want to understand where the market is going next, stop watching the headlines about average price. Watch the payments. If this breakdown helped you make sense of the Canadian market, hit the like button and subscribe to The Lab. We are tracking these shifts every week so you can make smarter moves with your money. What are you seeing in your local city? Are buyers waiting for a crash? Or are the monthly payments simply the wall they can't get over? Let's talk in the comments. I will see you in the next one.